I'm sure you've heard the news. Silver, one of the world's oldest and most trusted assets, is suddenly off limits. Overnight, the government has enacted a sweeping ban on all forms of silver trading, physical, digital, and even derivatives, leaving millions of investors and industries in a state of shock and disbelief. This isn't just a minor regulatory tweak, it's a seismic shift that's upending the very foundation of global markets. The government's sudden move to ban silver trading has sent shockwaves through the financial world, dominating headlines and sparking panic among investors. Silver, long considered a safe haven in times of uncertainty, is now at the center of a global crisis. The ban was announced with little warning, catching both retail and institutional investors completely off guard. As news broke, financial markets reacted instantly, stock indices tumbled, commodities plunged, and the value of silver-related assets evaporated in minutes. Within hours, prices began swinging wildly. Markets are in turmoil, confusion is everywhere, and investors are scrambling to make sense of what comes next. The ban has not only frozen trading but also triggered a cascade of margin calls, forced liquidations, and widespread uncertainty about the future of silver as an asset class. For many, this is reminiscent of past financial crises, but the speed and scale of the current chaos are unprecedented. This isn't just another blip, it's a dramatic repricing that's catching even the pros off guard. The ban has triggered a chain reaction, exposing vulnerabilities across the entire financial system. Major banks and hedge funds with significant exposure to silver are now facing massive losses, while smaller investors are left in limbo, unable to access or liquidate their holdings. The ripple effects are being felt far beyond the trading floors, impacting industries that rely on silver for manufacturing, electronics, and medical devices. The gap between paper and physical silver is widening fast, revealing deep cracks in the system. Some investors can't access their holdings or so, while others are left wondering if their assets are safe at all. Physical silver is becoming scarce, with dealers suspending sales and prices diverging sharply from official market rates. Meanwhile, digital platforms are freezing accounts, and paper contracts are being rendered worthless overnight. This disconnect is fueling even more anxiety, as people question the reliability of the entire financial infrastructure. So, why does this matter? Silver isn't just a shiny metal, it's a cornerstone of industry, technology, and personal wealth. From solar panels and electronics to medical equipment and national reserves, silver plays a critical role in the global economy. The ban threatens to disrupt supply chains, inflate costs for manufacturers, and undermine confidence in the broader financial system. In this video, we'll break down what's really happening, the immediate fallout, and what it means for you as an investor. We'll explore the reasons behind the ban, the potential long-term consequences, and the strategies you can use to protect your wealth in these uncertain times. Let's dive in. Coming off the heels of the silver ban, it's important to understand why this move has sent shockwaves through the market. To really grasp what's at stake, let's go back in time to before 1965, when quarters were made of 90% silver. These coins weren't just pocket change, they were a direct link to the tangible value of precious metals. In those days, every quarter you spent contained real silver, a metal prized for its rarity and industrial uses, as well as its role as a store of wealth for centuries. Back then, a quarter had a face value of 25 cents, but because of its silver content, that same coin is now worth about $4 just for its metal. This isn't just a quirky fact, it's a powerful illustration of how the value of money can shift dramatically over time. The silver in those coins has held its worth, even as the paper dollar has steadily lost purchasing power. Here's the key: while the price stamped on the coin stayed the same, its real-world value soared as the dollar lost purchasing power over decades. This is a classic example of the difference between price and value. The price is what you see on the coin, but the value is what it can actually buy you in the real world. As inflation erodes the dollar, the intrinsic value of silver remains resilient, often increasing as people seek safe havens for their wealth. For example, in the 1960s, a quarter could buy a gallon of gas. Today, a modern quarter buys almost nothing, but that old silver quarter can still buy a gallon, or more, because of its metal value. This isn't just nostalgia, it's a real measurable shift in what your money can do. The silver quarter's value has kept pace with inflation, while the modern quarter, made of base metals, has not. This is the core lesson. Silver preserves, and even increases, its value as the dollar is debased by inflation and policy changes. When governments print more money or change the rules of the game, paper currency loses value, but silver, with its limited supply and universal appeal, stands strong. That's why investors and savers have turned to silver for centuries, especially in times of economic uncertainty. So as the silver ban unfolds and market chaos grabs headlines, remember, It's really about the shrinking worth of the dollar, not the metal itself. The volatility in headlines are symptoms of a deeper issue, the ongoing erosion of fiat currency's value. Understanding this dynamic and the lesson of the silver quarter is crucial for anyone looking to protect their wealth and make informed decisions in today's unpredictable financial landscape. Throughout history, silver has served as a brutally honest measuring stick for purchasing power. Unlike paper money, which can be created at the whim of governments and central banks, silver's value is rooted in its scarcity and the effort required to mine and refine it. This fundamental difference means that while the value of paper currency erodes with every new bill printed, silver remains steadfast, a tangible asset that resists inflationary pressures. Governments have the power to print as much money as they see fit, often in response to economic crises or political pressures, but they cannot simply create more silver out of thin air. This is why, over the decades, the same ounce of silver that could buy a week's worth of groceries in the 1970s or 1980s can still purchase a similar basket of goods today. In stark contrast, the purchasing power of paper money has steadily declined. What once bought a cart full of essentials now barely covers a handful of items. This isn't just a theoretical concept, it's a reality reflected in everyday life, as anyone comparing old and new receipts can attest. When people begin to flock to silver, it's more than just a financial move. It's a collective vote of no confidence in the currency. This shift often happens during periods of economic uncertainty, when trust in government-issued money wanes. Silver, with its long history as a store of value, becomes a safe haven. It holds its purchasing power, even as fiat money loses ground. This is why, in times of crisis, you'll often see increased demand for physical silver, as individuals seek to protect their wealth from the silent tax of inflation. Rising silver prices are often a clear signal of underlying economic distress. They expose the fragility of a debt-driven financial system, where the value of money is constantly undermined by excessive borrowing and relentless money printing. In this context, silver isn't just a commodity, it's a practical tool for measuring what your money can really buy. When the price of silver surges, it's a warning sign that the currency is losing its grip on value and that the economic system may be under strain. Ultimately, silver's most important job is to reveal the truth about currency debasement. It acts as a mirror, reflecting the real impact of monetary policy decisions and government spending. This is precisely why the financial system often resists the rise of silver, because it keeps us honest about what our money is truly worth. In a world where numbers on a screen can be manipulated, silver stands as a physical reminder of value, trust, and economic reality. For most of modern history, silver was regarded as just another industrial commodity, an essential raw material quietly powering the backbone of our technological world. From the intricate wiring inside your smartphone, to the reflective surfaces of solar panels, and even the sterile tools in hospitals, silver's unique properties made it indispensable across countless industries. Its high conductivity, antimicrobial qualities, and malleability ensured steady demand, and for decades, the silver market was largely shaped by the push and pull of industrial supply and demand. But in recent years, silver's role has dramatically evolved. It's no longer just a passive ingredient in manufacturing. It has become a critical stress test for the entire financial system. This transformation became glaringly obvious during market shocks like the 2021 silver squeeze, when a wave of retail investors, galvanized by online communities, challenged the dominance of Wall Street institutions. Suddenly, silver was thrust into the spotlight, not for its industrial value, but for its ability to expose the vulnerabilities and imbalances lurking beneath the surface of global finance. The divergence between paper and physical silver became a glaring warning sign. During the squeeze, premiums for physical silver soared to unprecedented levels, while the so-called paper price, set by futures contracts and ETFs, lagged far behind. This gap wasn't just a technical anomaly, it was a signal that the mechanisms underpinning the market were under severe strain. Investors who wanted real tangible silver found themselves facing delays, shortages, and soaring costs, while digital contracts continued to trade as if nothing had changed. As the paper markets became increasingly disconnected from reality, the consequences rippled through the entire ecosystem. Physical silver supplies dried up, dealers posted sold-out signs, and contracts that once represented a claim on real metal began to lose credibility. The very foundation of trust in the market, confidence that paper claims could be converted into physical silver, was shaken, revealing just how fragile the system had become. In this new reality, silver has become the canary in the coal mine, a sensitive early warning system for deeper problems within the financial world. Its price movements and supply disruptions now serve as signals that something is amiss, alerting investors and policymakers alike to underlying risks that might otherwise go unnoticed. These wild swings in silver's price expose the cracks in a world built on leverage and paper promises. When sudden margin calls hit, funds are forced to liquidate their positions, amplifying volatility and triggering a cascade of selling across markets. The result is a feedback loop where financial stress in one corner of the market can quickly spread, destabilizing the entire system. The chaos that erupts during these episodes isn't really about silver itself. Instead, it's a reflection of the fragility and interconnectedness of the financial system that silver now helps to reveal. Each shortage, each price spike, and each trading halt is a symptom of deeper structural issues that extend far beyond the metal's industrial uses. Each spike and shortage in the silver market peels back another layer, revealing deeper issues, like a lack of transparency, excessive leverage, and the growing disconnect between financial products and real-world assets. These events force both investors and regulators to confront uncomfortable truths about how modern markets operate, and how quickly trust can evaporate when the system is pushed to its limits. Today, the price of silver has become more than just a reflection of supply and demand. It now serves as a real-time barometer of trust in the financial system itself, a gauge of how much faith investors have in the promises made by banks, brokers, and exchanges. In this new era, silver is no longer just a commodity, it's a real-time indicator of financial stress, a litmus test for the health of the system, and a stark reminder that beneath the surface of modern markets, fragility and risk are never far away. What we're witnessing right now isn't just another episode of market turbulence. This is not the kind of volatility that traders expect and prepare for in their daily routines. Instead, it's a violent repricing event, an abrupt seismic shift where prices don't merely oscillate within a predictable range, but instead lurch and convulse in response to sudden destabilizing shocks. These are the moments when the market's underlying assumptions are called into question, and the very foundation of price discovery is shaken. For years, the financial system operated on the belief that paper silver, contracts, futures, and other derivatives was essentially interchangeable with physical silver stored in vaults. But now, that assumption has been shattered. The gap between what's traded on paper and what actually exists in physical form has been exposed, revealing a fundamental disconnect. This isn't just a technicality, it's a structural flaw that undermines trust in the entire market mechanism. Violent repricing events are often triggered by a sudden loss of confidence, sometimes sparked by regulatory changes, unexpected news, or a collective realization that the old rules no longer apply. In these moments, investors and institutions scramble to secure real, tangible assets, abandoning paper promises that suddenly seem unreliable. The result is a frantic, almost panicked search for a new equilibrium, with prices swinging wildly as the market tries to find its footing. These swings are not just numbers on a screen. They represent a deep uncertainty about what assets are truly worth and who will be left holding the bag when the dust settles. If you're still relying on old models and historical data to guide your decisions, you're in dangerous territory. The rules of the game have changed, and the patterns of the past no longer offer reliable guidance for the future. In times of violent repricing, yesterday's strategies can quickly become today's liabilities, leaving even seasoned professionals disoriented and exposed. The violent price action we're seeing is the market's way of slamming on the brakes, a stark warning that the very structure of the market is under threat. When this happens, liquidity can evaporate in an instant, forcing traders and institutions to liquidate positions at any price just to survive. This cascade of forced selling can trigger a chain reaction, spreading instability across markets and even threatening the broader financial system. What we're experiencing is not just a temporary price dip or a routine correction. This is a structural break, a fundamental rupture in the way markets function. The consequences of such an event can ripple outward for years, reshaping regulations, altering investor behavior, and changing the very nature of financial markets. In the aftermath, the landscape will look very different, and those who fail to adapt risk being left behind as the new reality takes hold. When most people think of investing in silver, they imagine shiny coins or hefty bars locked away in a safe. But in reality, the silver market is split into two very different worlds, paper silver and physical silver. Understanding the distinction between these two markets is crucial because they operate on entirely different principles and their prices can behave in dramatically different ways, especially during times of financial stress or market upheaval. Paper silver refers to financial instruments like futures contracts, exchange-traded funds, and other derivatives that represent claims to silver but not the metal itself. These products are designed for convenience and liquidity, Investors can buy or sell paper silver with a few clicks, often without ever seeing or touching a single ounce of the metal. In fact, the vast majority of silver traded on global markets exists only as numbers on a screen, contracts, not coins. The scale of this market is staggering. For every ounce of physical silver in a vault, there can be dozens, sometimes even hundreds of ounces worth of paper claims circulating in the financial system. This means that, in theory, if everyone tried to redeem their paper silver for real metal at once, there simply wouldn't be enough to go around. Physical silver, by contrast, is the tangible, real-world metal you can hold in your hand. It comes in the form of coins, bars, and rounds, and it requires secure storage, insurance, and sometimes even transportation. Unlike paper silver, you can't just click a button to buy or sell physical metal instantly. Transactions often involve finding a reputable dealer, negotiating a price, and arranging for delivery or pickup. And when it comes time to sell, you need a willing buyer and a way to transfer the actual silver. This process can be slower and more cumbersome, but it offers something paper silver never can: direct ownership of a real finite asset. The differences between these two markets become especially stark during periods of market turmoil. Imagine a sudden panic, perhaps triggered by economic uncertainty, geopolitical tensions, or a major financial institution failing. In the paper-silver market, traders can dump contracts in seconds, causing prices to plummet as everyone rushes for the exits. But at the very same time, physical silver dealers may find themselves overwhelmed by demand, with shelves quickly emptying and premiums, the extra cost above the spot price, soaring. In these moments, the price of paper silver can crash, while the price of real physical silver spikes, sometimes to record highs. This divergence can be dramatic. During past crises, we've seen paper silver prices collapse due to forced selling and margin calls, while physical silver becomes almost impossible to find. Dealers slap hefty premiums on whatever inventory remains, sometimes doubling or even tripling the official spot price. Online retailers post sold-out notices, and buyers scramble to secure any available metal, regardless of cost. The disconnect between the two markets becomes impossible to ignore. What does this gap really mean? It's the market's way of screaming that paper promises are no substitute for the real thing, especially when trust is in short supply. Investors who thought they owned silver through a digital account suddenly realize that, in a crisis, what they actually own is just a claim, a promise that may or may not be honored. Meanwhile, those holding physical silver have something tangible, something that can't be defaulted on or diluted by financial engineering. When this decoupling happens, it's a clear signal that the two worlds, paper silver and physical silver, are moving in opposite directions. Each tells a different story about trust, value, and risk. Paper silver may offer speed and convenience, but in times of crisis, it's the physical metal that investors truly crave. Understanding this divide is essential for anyone serious about protecting their wealth in an uncertain world. When supply tightens and bans loom on the horizon, the natural expectation is that prices will surge. This is a classic economic response. Scarcity drives value. We saw this play out dramatically during the famous 1980 silver squeeze, when the Hunt brothers attempted to corner the market, and again, in the 2022 nickel market turmoil, where sudden supply constraints sent shockwaves through the system. In both cases, the world watched as inventories dwindled and panic set in among traders and investors alike. But what actually happens in these moments of crisis often defies simple logic. Instead of prices continuing to climb, we frequently witness a sudden and violent collapse in paper prices. Take the 1980 silver episode. After prices skyrocketed due to aggressive buying and tightening supply, the market abruptly reversed. The Hunt brothers, heavily leveraged, faced massive margin calls. As they and other traders scrambled to meet these demands, forced selling overwhelmed the market, causing prices to plummet almost overnight. This pattern is not unique to silver. In the 2022 nickel market, a similar dynamic unfolded. Leveraged traders, caught off guard by a supply squeeze and rapid price movements, were hit with margin calls. Unable to post additional collateral, they were forced to liquidate their positions at any price, accelerating the downward spiral. The result? A market freeze, panic, and a sharp drop in paper prices, even as the underlying physical commodity remained in high demand. This cascade of liquidations is a hallmark of highly leveraged markets. When prices start to fall, margin calls force more and more participants to sell, regardless of the fundamentals. Each sale pushes prices lower, triggering even more margin calls in a self-reinforcing feedback loop. The trading floor empties out, and what began as a supply-driven rally ends in a wave of forced selling and market capitulation. Importantly, these collapses are rarely about weak demand for the physical commodity. In fact, during such crises, physical demand often remains robust or even intensifies. We've seen lines outside bullion dealers surging premiums for physical metal and a scramble for tangible assets. The disconnect between paper and physical markets becomes stark, as investors seek safety in real goods while paper contracts are liquidated en masse. The root cause of these collapses is excessive leverage. When too many traders are betting with borrowed money, the system becomes fragile. Headlines may scream about shortages and supply constraints, but the real danger lies in the financial structure of the market itself. As leverage builds, the market becomes increasingly vulnerable to shocks. Any disruption can trigger a chain reaction of margin calls and forced selling. Ultimately, as leverage unwinds, paper prices collapse, even as the headlines continue to warn of shortages. This is a recurring theme in commodity markets. History repeats itself whenever speculation and leverage outpace the underlying fundamentals. The lesson is clear. When markets become overstretched, the unwinding of leverage can be far more powerful than any supply shortage, leading to dramatic and often unexpected price movements. When markets become extremely volatile, as we've seen during the recent silver ban, investors are thrust into a psychological minefield. The most common emotional triggers, fear and greed, can override rational thinking in seconds. Fear often leads to panic selling at the very bottom, while greed fuels FOMO, or the fear of missing out, causing people to buy at unsustainable highs. But these are just the surface-level reactions. Beneath these emotions lie deeper psychological traps. One of the most insidious is confirmation bias. This is when investors only seek out information that supports their existing beliefs or hopes, ignoring any evidence to the contrary. For example, someone convinced that silver will rebound might only read bullish articles, filtering out warnings or negative data. Another common pitfall is herd mentality, blindly following the crowd, assuming that if everyone else is buying or selling, it must be the right move. This can lead to bubbles inflating rapidly, or mass sell-offs that drive prices far below their true value. Market makers and institutional players are well aware of these psychological vulnerabilities. They often exploit them, deliberately triggering stop losses or spreading rumors to shake out weak hands, those who are most likely to act on emotion rather than logic. But the real driver behind dramatic price crashes isn't just panic or manipulation. It's often the unwinding of leverage. When too many investors borrow money to amplify their bets, even a small price drop can force mass liquidations, creating a cascade effect. This leverage unwinding can send prices plummeting, even if underlying demand remains strong. Consider the story of Sarah. In 2020, as silver prices tumbled, she panicked and sold her entire position, convinced the crash would continue. Just days later, the market rebounded sharply, leaving her on the sidelines, watching others recover their losses and more. Then there's Mike, who, after reading only bullish headlines and ignoring warning signs, bought at the very peak. He was swept up by the optimism of the crowd, only to see his investment quickly lose value. These stories are not unique, they're repeated in every market cycle, across every asset class. By understanding these psychological traps, fear, greed, confirmation bias, herd mentality, and the dangers of leverage, you can start to see market crashes not as threats, but as opportunities. The most successful investors are those who remain calm, analyze the situation objectively, and learn from their mistakes. They use downturns to buy quality assets at a discount, rather than selling in a panic or chasing hype. Without this knowledge and self-awareness, you're left reacting emotionally to every twist and turn in the market, just like countless investors before you. But with the right mindset and understanding, you can break free from these traps, make better decisions, and turn chaos into opportunity. Whenever rumors or official announcements of a ban hit the market, the immediate reaction is a surge in uncertainty and fear. This uncertainty is not just limited to retail investors, it ripples through every layer of the financial system, from individual traders to large institutional players. The mere suggestion of a ban, whether on silver, gold, or any other commodity, can trigger a chain reaction. Leveraged traders who have borrowed money to amplify their positions are especially vulnerable. They know that any sudden regulatory change could wipe out their investments in seconds. As a result, they rush to de-risk by selling off their positions as quickly as possible. This is exactly what happened during the infamous 1980 silver crash, when the Hunt brothers' attempt to corner the silver market led to the introduction of trading restrictions. The market responded with panic selling and prices collapsed almost overnight. The lesson here is clear. Bans and crashes are often two sides of the same coin, with fear and uncertainty acting as the bridge between them. This mass selling, often described as a stampede for the exits, triggers a sharp crash in the paper market, the market for futures, options, and other financial contracts tied to the commodity. But here's the paradox. While paper prices are plummeting, physical demand often surges. Take the example of India's gold import ban in 2013. As soon as the ban was announced, paper gold prices dropped sharply, reflecting the panic and forced selling in the financial markets. But on the ground, something very different was happening. Physical gold premiums soared as buyers scrambled to get their hands on actual gold. Jewelry shops were packed, and people were willing to pay far above the official price just to secure physical supply. This divergence between paper and physical markets is a hallmark of ban-induced crashes. The ban effectively splits the market in two. On one side, you have the paper market, where prices are falling rapidly due to forced liquidations and margin calls. On the other side, the physical market sees premiums skyrocket as real-world buyers compete for limited supply. This phenomenon has played out repeatedly, not just in silver and gold, but in other commodities as well. During past bans, such as the 1980 silver crash and the 2013 gold import restrictions in India, the disconnect between paper and physical prices became glaringly obvious. Investors who understood this dynamic were able to navigate the chaos more effectively, while those who didn't were often left with heavy losses or unable to secure physical assets at any price. It's important to understand that the crash is not about a sudden lack of demand for the underlying asset. Instead, it's about the urgent need to unwind risk. When bans or restrictions are announced, traders and investors are forced to exit their positions, often at any price. This creates a cascade of selling that drives prices down, even as real-world demand remains strong or even increases. In every major market shock, whether it's the 1980 silver crash, the 2008 financial crisis, or the 2013 gold ban in India, the common thread is the scramble to exit leveraged or speculative positions. The resulting price collapse is a function of market structure and risk management, not a reflection of the asset's true value or demand. Ultimately, the ban acts as a catalyst, exposing the underlying fragility of the financial system. It reveals just how dependent markets are on confidence, liquidity, and the ability to freely trade. When that confidence is shaken, whether by regulatory action, rumors, or outright bans, the system's vulnerabilities are laid bare. We saw this in 1980, when silver trading was abruptly restricted, in 2013, when India's gold market was upended, and during countless other financial shocks throughout history. Each time the pattern repeats, bans trigger panic, panic triggers crashes, and the true state of the market is revealed in the aftermath. Understanding this cycle is crucial for anyone hoping to navigate turbulent markets and protect their wealth when the next ban or crash arrives. Volatility isn't just chaos, it's like an earthquake for the financial world, shaking the ground and exposing what's hidden beneath the surface. When markets experience sudden, sharp movements, it's not merely noise or random panic. These moments act as stress tests, revealing the true health and underlying structure of the financial system. Just as a receding tide exposes debris and hidden dangers on the ocean floor, every wild market swing uncovers leverage, risky bets, and weak points that were previously masked by calm conditions. In times of low volatility, it's easy for institutions and investors to hide excessive risk-taking, off-balance sheet liabilities, or unsustainable business models. But when volatility surges, these vulnerabilities are laid bare for all to see. Volatility acts like a rigorous audit, forcing every player in the market to prove they have real capital, tangible assets like gold in hand or cash reserves, not just paper promises or digital numbers on a screen. During periods of market stress, those who have overextended themselves or relied on borrowed money are quickly exposed. Margin calls, liquidity crunches, and forced liquidations separate the truly solvent from those who were simply riding the wave. In this way, volatility maps the fault lines in the financial system, much like cracks in the earth reveal where an earthquake might strike next. These stress points, whether they're over-leveraged hedge funds, fragile banks, or vulnerable sectors, become visible only when the ground shakes. By studying these patterns, analysts and investors can identify systemic risks and anticipate where future crises might erupt. So don't fear the swings, read them as vital signals, like a seismograph for the markets, telling you where to look closer. Volatility is not just a source of anxiety, it's a powerful diagnostic tool. By paying attention to how different assets, institutions, and investors respond under pressure, you gain insight into the true state of the market and can make more informed decisions. In the end, volatility doesn't just create chaos, it reveals the truth, helping us understand where the system is strong and where it's dangerously fragile. When we talk about a ban, especially one that shakes the financial markets, it's crucial to understand that it doesn't happen in a single isolated moment. Instead, a ban is a complex, multi-stage process that unfolds over time, with each phase introducing new layers of uncertainty, speculation, and reaction. This gradual progression is what truly drives the chaos and volatility that ripple through the market. It all begins with the earliest whispers, rumors that start to circulate quietly among insiders, financial professionals, and market watchers. These rumors might be sparked by a leaked memo, a cryptic comment from a regulator, or even a sudden shift in trading patterns. As these whispers spread, they quickly find their way into offices, conference rooms, and most importantly, onto social media platforms and financial news outlets. The result? A surge of anxiety and speculation among investors, who are left trying to decipher what's real and what's just noise. As the rumors intensify, uncertainty begins to take hold. Investors and traders scramble to position themselves, often making rapid decisions based on incomplete or conflicting information. This is a critical stage, because the lack of clarity forces people to act defensively, selling off assets, hedging their bets, or even pulling out of the market entirely. The atmosphere becomes charged with tension, as everyone tries to anticipate what might happen next, but no one has the full picture. The market itself doesn't wait for official confirmation. Instead, it reacts preemptively, sometimes violently, to the growing uncertainty. Prices can swing wildly as investors rush to adjust their positions, leading to increased volatility and, in some cases, sharp declines. Trading floors become tense, with professionals glued to their screens, watching for any sign of clarity or confirmation. The psychological impact is profound, as fear and doubt spread faster than any official announcement ever could. By the time a ban is formally declared, often through a press conference, regulatory filing, or breaking news alert, most of the market's reaction has already played out. The official announcement is almost a formality, confirming what many already suspected or feared. The real damage, the panic selling, the price collapses, the shattered confidence, has already occurred in the hours or days leading up to the announcement. What you're witnessing in these moments is not a single sudden event, but a process unfolding in real time, step by step, as uncertainty gives way to chaos, and, eventually, to a new normal. Understanding this process is key to making sense of the market's behavior during times of crisis. When a silver ban is announced, the market erupts into chaos as each participant scrambles to protect their interests. Short-term traders, who typically operate with high leverage and razor-thin margins, are often the first to react. They rapidly dump paper contracts, such as futures and options, hoping to exit their positions before liquidity dries up or prices collapse further. This initial wave of selling can trigger a cascade effect, amplifying volatility and deepening the sell-off. Hedge funds, which may have significant exposure through complex derivatives or leveraged bets, move swiftly to unwind their positions. Their risk management teams assess exposure in real time, issuing urgent instructions to cut losses or rebalance portfolios. The speed and scale of these moves can send shockwaves through the market, as large block trades hit the order books and further depress prices. Meanwhile, day traders, who thrive on volatility but fear being caught on the wrong side of a sudden move, frantically monitor multiple screens, searching for exit points or opportunities to profit from the chaos. Many try to front-run the broader market, but the sheer speed of information flow means even the most agile can be caught off guard. On the physical side, precious metals dealers and coin shops face a different set of challenges. As news of the ban spreads, retail and institutional demand for physical silver surges. Dealers scramble to secure inventory, often raising premiums dramatically to manage both risk and overwhelming demand. In some cases, they halt sales entirely, unwilling to sell into a market where replacement inventory is uncertain or unavailable. Online bullion retailers update their websites in real time, posting out-of-stock notices and adjusting prices upward to reflect the new reality. Local coin shops may put up signs indicating no silver is available, while phone lines and email inboxes are flooded with inquiries from anxious buyers. For industrial buyers, such as technology manufacturers, automotive companies, and electronics firms, the stakes are even higher. Silver is a critical input for many high-tech applications, from solar panels to medical devices. As the ban threatens future supply, procurement teams rush to lock in physical silver at any price, fearing production slowdowns or shutdowns. Some negotiate long-term contracts with suppliers, hoping to secure stable deliveries despite market turmoil. Others, unable to source enough metal, begin exploring alternative materials or redesigning products to reduce silver content. The urgency is palpable, with procurement officers working around the clock and escalating negotiations to the highest corporate levels. These frantic moves by traders, dealers, and industrial users rapidly drain the physical silver market. Inventories in warehouses and vaults plummet as buyers snap up whatever is available. Logistics teams are forced to prioritize shipments, sometimes rerouting deliveries to the highest bidders or most critical customers. Security becomes a concern as the value of remaining stock soars, with guards and surveillance ramped up to deter theft or fraud. The sense of scarcity grows, feeding a feedback loop of panic buying and hoarding. Each group in the market is driven by distinct incentives and constraints. Traders are laser-focused on minimizing losses and managing risk exposure, often acting with little regard for the underlying metal. Dealers must balance the need to serve customers with the risk of being unable to restock inventory. Industrial buyers are motivated by the imperative to keep factories running and fulfill contracts, sometimes at any cost. Retail investors, spurred by fear of missing out or distrust of paper assets, rush to buy physical silver, lining up outside coin shops and sharing stories of shortages on social media. These competing motivations intensify the split between the paper and physical markets, with prices and availability diverging sharply. The end result is a market pulled violently in opposite directions. Paper-silver prices may plunge as contracts are liquidated, while physical premiums soar due to scarcity. Volatility spikes, uncertainty reigns, and trust in the market structure is shaken. For everyone involved, whether trader, dealer, industrial user, or retail investor, the silver ban signals not just a regulatory change, but a fundamental shift in how risk, value, and opportunity are perceived and acted upon. When you look at the price of silver on your screen, what you're actually seeing is the price of paper futures contracts, essentially promises to deliver silver at a future date. These prices are set in real time, reacting instantly to changes in trader sentiment, perceived risk, and breaking news. But here's the key: these prices don't always reflect the true physical supply of silver in the world. Instead, they're shaped by the psychology of the market and the mechanics of futures trading. When a government or regulatory body announces a ban or restriction on silver trading, it sends shockwaves through the futures market. Traders immediately worry that their contracts might not be settled with actual metal, but with cash instead. This is a huge deal, because many investors buy futures contracts specifically to gain exposure to real, physical silver. If there's a risk they'll be paid out in dollars rather than metal, the value of those contracts drops in the eyes of the market. As a result, traders rush to sell their positions, hoping to get out before the contracts lose even more value. This sudden collective rush to the exits creates a classic herd mentality. Fear and uncertainty take over, and the selling becomes self-reinforcing. As more traders dump their contracts, the paper price of silver falls even further, sometimes dramatically. All of this can happen even as the actual physical supply of silver is tightening, meaning it's getting harder and harder to find real silver bars or coins for sale at any price. The reason for this disconnect lies in the very nature of the futures market. It's a marketplace built on risk management, speculation, and psychology, not on the direct exchange of physical goods. Traders are constantly weighing the risks of holding contracts versus the potential rewards, and their decisions are often driven by fear, rumors, and short-term news rather than by the underlying fundamentals of supply and demand. So, even as physical silver becomes scarce and premiums for real metal rise, the paper price can fall sharply, sometimes creating a bizarre situation where silver is both cheap on paper and nearly impossible to buy in the real world. Understanding this dynamic is crucial for anyone investing in precious metals. The futures market can send misleading signals about scarcity, and price drops in the paper market don't always mean silver is suddenly abundant. In fact, they can be a warning sign that real-world shortages are about to get much worse. When we talk about a flash crash in the silver market, we're not describing a moment of collective panic among traders. Rather, we're witnessing a highly technical, almost clinical breakdown in the market's underlying machinery. Flash crashes are mechanical events, set off by a cascade of automated systems that react to each other in fractions of a second, often with little to no human intervention. These events are a stark reminder of how modern financial markets have evolved, where algorithms and high-speed trading dominate the landscape. In thinly traded markets like silver, the stage is set for instability. All it takes is a single, unusually large sell order, sometimes from a major institution, sometimes from an algorithmic trading bot, to tip the balance. When this order hits the market, it can instantly overwhelm the available buyers, causing prices to drop sharply. This sudden move triggers a domino effect. Stop-loss orders, which are preset by traders to limit their losses, are activated en masse. These stop losses automatically convert into market sell orders, adding even more downward pressure. At this point, high-frequency trading algorithms, designed to detect and exploit even the smallest price movements, spring into action. These bots are programmed to react in milliseconds, far faster than any human could. They detect the initial drop and begin selling aggressively, not out of fear, but because their code tells them to follow the momentum. This creates a feedback loop. As the algorithms sell, prices fall further, which in turn triggers more selling by other bots and stop losses. The result is a dramatic plunge in prices, often occurring within seconds or minutes. What's striking is that this collapse happens on very little actual trading volume. The majority of the action is driven by automated systems, each sale triggering another, creating a self-reinforcing spiral. Human traders, caught off guard, can do little to intervene in real time. The price chart becomes a near vertical line downward, and the market appears to be in free fall. This is the essence of a feedback loop in automated trading. Each algorithm is designed to minimize risk and maximize profit, but when they all react to the same signals, they amplify the original move. The market becomes a battleground of machines, with little human oversight to slow or reverse the momentum. In these moments, the market structure is laid bare, revealing just how much control has shifted from people to code. The aftermath is a price collapse that often bears little resemblance to silver's true underlying value. Instead, what you see is the result of market mechanics, thin liquidity, automated selling, and the relentless speed of modern trading systems. Prices may recover just as quickly as they fell, but the damage to confidence and the perception of stability can linger for much longer. Ultimately, flash crashes in silver expose deep vulnerabilities in the market structure. Thin liquidity means there aren't enough buyers and sellers to absorb shocks. Over-reliance on algorithms creates a system where automated responses can spiral out of control, and the sheer speed of modern trading leaves little room for human judgment or intervention. These events serve as a warning. As markets become more automated and interconnected, the potential for sudden, severe disruptions only increases, making it crucial for regulators, traders, and investors to understand and address these systemic risks. Imagine the global financial system as a vast, intricate machine, one that relies on a constant flow of liquidity to function. Liquidity, in this context, is like the oil that keeps every gear, piston, and valve moving smoothly. Without enough oil, even the most powerful engine will grind to a halt. And the same is true for financial markets. When liquidity is abundant, transactions flow easily, credit is available, and markets remain stable. But when liquidity dries up, the entire system can seize, leading to cascading problems across the financial landscape. When liquidity vanishes, it's like running an engine without oil. Friction builds, parts overheat, and eventually, everything stops working. In financial terms, this means banks and traders can't access the cash they need to meet obligations, pay debts, or fund new trades. The stress quickly spreads, causing panic, forced selling, and even institutional failures. This is why central banks and regulators watch liquidity levels so closely. A sudden shortage can trigger a full-blown crisis. One of the most critical components in this system is the repo market, short for repurchase agreement market. Think of the repo market as a high-speed lending pit stop for banks and large financial institutions. Here they can quickly borrow cash, using securities like government bonds as collateral to meet short-term needs. If the repo market gets clogged, meaning lenders become reluctant or rates spike, banks can't get the cash they need. This stress doesn't stay contained, it ripples outward, affecting everything from stock prices to the ability of companies to make payroll. Margin is another key concept. Think of it as a security deposit that traders must post to open and maintain positions in the market. When asset prices drop or liquidity tightens, brokers demand more cash from traders to cover potential losses. This is known as a margin call. If traders can't meet these demands, they're forced to sell assets, often at a loss, to raise the required funds. Margin calls can accelerate market declines, especially when many traders are caught off guard at the same time. If traders can't pay up, they're forced to liquidate their positions, sometimes at the worst possible moment, when prices are already falling and liquidity is scarce. This forced selling can create a vicious cycle, driving prices even lower and triggering more margin calls. In extreme cases, entire portfolios can be wiped out in a matter of hours, and the effects can spill over into other markets, including commodities like silver. So, when the repo market is under stress, when borrowing costs spike or liquidity evaporates, it's a major warning sign for the entire financial system. Forced selling can quickly follow, especially in markets that are already volatile or under pressure, like silver. A sudden drop in silver prices can be both a symptom and a cause of broader financial stress, as investors scramble to raise cash and meet margin calls. In short, the hidden plumbing of finance, liquidity, margin, and the repo market forms the foundation of modern markets. When any part of this system falters, the effects can be dramatic, triggering waves of volatility and forced selling, especially in sensitive markets like precious metals. Understanding these connections is crucial for anyone trying to navigate or anticipate the next big move in the financial world. When you see headlines screaming "bank bailout surge" splashed across newspapers and financial news sites, it's easy to assume the worst, that the entire banking system is on the verge of collapse. These sensational headlines are designed to grab your attention, but they often distort the reality of what's actually happening behind the scenes at central banks. The truth is far more nuanced, and understanding it is crucial for anyone trying to make sense of today's financial markets. Central bank interventions, such as the Federal Reserve's repo loans, are frequently mischaracterized by the media. These loans are not evidence that banks are insolvent or on the brink of failure. Instead, they're a response to short-term liquidity issues, meaning banks temporarily lack the cash to meet immediate obligations, not that their assets are worthless or that they're fundamentally unsound. The distinction between illiquidity and insolvency is critical, yet it's rarely explained in mainstream coverage. Illiquidity is like being short on cash for a bill, even though you have plenty of assets. Insolvency is when your debts outweigh your assets entirely. By failing to clarify this, the media creates unnecessary fear and confusion. The modern financial system is highly leveraged, meaning that banks and other institutions operate with relatively small cash reserves compared to the size of their obligations and investments. This leverage makes the system efficient, but it also means that even minor disruptions, like a sudden demand for cash or a sharp move in asset prices, can trigger a need for emergency support. When the Fed steps in with liquidity, it's not a sign that the system is collapsing, it's a routine measure to keep markets functioning smoothly. Unfortunately, headlines often exaggerate these interventions, making them seem like harbingers of doom and fueling widespread panic and misunderstanding among the public and investors alike. This environment of heightened fear and misinformation has real consequences. When liquidity dries up, it triggers margin calls, forcing investors to sell assets like silver to cover their positions, which can drive prices down sharply and create a feedback loop of stress in the markets. The Federal Reserve's interventions are not a sign of imminent collapse, but rather a symptom of the same systemic stress that's impacting metals markets and other assets. Social media and sensational reporting amplify these fears, but the reality is that these actions are designed to stabilize the system, not signal its demise. Understanding the true nature of these interventions helps cut through the noise and see the bigger picture. The financial system is under pressure, but it's not on the brink of failure every time the Fed steps in. Silver occupies a truly unique position in the world economy, serving as both a vital industrial metal and a trusted monetary asset. Its dual identity has made it indispensable for thousands of years, shaping civilizations and economies across continents. From the earliest days of trade, silver was prized not just for its beauty, but for its utility and rarity. Ancient empires, from Rome to China, relied on silver coins as the foundation of commerce, and its influence only grew as global trade expanded. For centuries, silver was the backbone of global trade, acting as the universal currency that connected distant markets. The Spanish pieces of 8, for example, became the world's first truly global currency, circulating from the Americas to Asia and Europe. In the United States, the silver dollar symbolized economic stability and national identity. But silver's story doesn't end with coins and currency. Its essential role in industry has only grown with time. Today, silver is a critical component in everything from electronics and solar panels to medical devices and batteries. This creates a constant, competing demand. Investors seek silver as a store of value and hedge against inflation, while industries rely on it for its unmatched physical properties. This tug-of-war intensifies during times of uncertainty, as both sides scramble for limited supply. History shows that during financial panics, silver's dual role as both money and commodity amplifies market volatility. In the 19th century, silver rushes fueled entire economies, driving mass migrations and shaping the destinies of nations. The collapse of the silver standard sent shockwaves through global markets, and even today, sudden shifts in silver's price can trigger widespread economic consequences. Leverage and speculation often magnify these swings, making silver a focal point in every financial quake. Silver's enduring importance is rooted in both its rich history and its indispensable role in modern industry. Whether as a symbol of wealth, a medium of exchange, or a critical industrial material, silver remains at the center of global attention, especially during times of crisis. Its story is one of constant adaptation, resilience, and relevance, ensuring that whenever markets tremble, silver is always in the spotlight. When we talk about the divergence between paper and physical silver, we're referring to a phenomenon that has become increasingly visible during periods of market stress, most notably during the 2021 silver squeeze. The paper price, which is determined by futures contracts and other financial instruments traded on exchanges like the COMEX, can collapse rapidly due to forced selling. This is often triggered by large institutional players unwinding positions, margin calls that force traders to liquidate. or even algorithmic trading amplifying the downward momentum. In these moments, the price you see on your screen, the so-called spot price, can plummet, seemingly disconnected from the real-world demand for the metal. Meanwhile, in the physical market, a completely different story unfolds. As the paper price drops, retail investors and even some institutions rush to buy actual silver coins, bars, and rounds. Dealers quickly sell out of inventory, and online platforms display out-of-stock notices within hours. This surge in demand causes premiums, the extra amount buyers are willing to pay above the spot price, to skyrocket. During the 2021 silver squeeze, premiums on popular coins like American Silver Eagles soared to record highs, and many buyers found themselves unable to purchase any physical silver at all, regardless of the quoted spot price. This disconnect leads to scenes rarely witnessed in modern financial markets. Long lines outside coin shops, anxious customers hoping to secure even a small amount of metal, and frustrated buyers being turned away empty-handed. The physical shortage becomes so acute that even those willing to pay hefty premiums sometimes leave with nothing. This is a stark contrast to the world of paper silver, where contracts can be bought and sold in massive quantities with just a few clicks, but actual delivery of metal is rare. The gap between paper and physical prices is more than just a number. It's a direct reflection of trust, or the lack thereof, in the financial system. In 2021, this gap widened to unprecedented levels, with physical silver sometimes selling for 30%, 40%, or even 50% above the spot price. This divergence is a clear signal that market participants no longer believe the paper price accurately represents the true value of silver, especially when it comes to actual, deliverable metal. The wider this gap grows, the more it reveals underlying problems in the market structure. Investors begin to question the reliability of paper contracts, wondering if these promises can actually be fulfilled with real metal in times of crisis. The market's dislocation becomes a topic of intense debate among analysts, financial news anchors, and everyday investors alike, all trying to make sense of a system that appears increasingly fragile. Ultimately, the paper-physical divergence is the clearest warning sign that the system's paper promises are failing. When trust in the ability to deliver real metal erodes, the entire foundation of the market is called into question. We saw this play out in recent disruptions, where the breakdown between paper and physical markets exposed deep vulnerabilities, and reminded everyone that, in the end, only the real thing truly matters. When we look at gold, it's clear why it has earned its reputation as the ultimate store of value. Over 200,000 metric tons of gold have been mined throughout human history, and remarkably, almost all of it still exists today. Gold is virtually indestructible. It doesn't tarnish, corrode, or degrade over time. That's why the vast majority of gold ever extracted is still held in some form, whether as bullion in central bank vaults, as jewelry passed down through generations, or as coins and bars in private collections. This immense above-ground stockpile means that gold's supply is relatively stable and predictable, and its price is largely driven by investment demand, central bank policies, and macroeconomic factors, like inflation and currency movements. Silver, on the other hand, plays a very different role in the global economy. While it is also a precious metal and a popular investment, silver is fundamentally an industrial metal as well. In fact, about 60% of annual silver demand comes from industrial uses. Silver's unique physical and chemical properties, such as its unparalleled electrical and thermal conductivity, reflectivity, and antibacterial qualities, make it indispensable in a wide range of industries. It's a critical component in electronics, where it's used in circuit boards, switches, and connectors. It's essential for the production of solar panels, which are rapidly expanding as the world transitions to renewable energy. Silver is also found in medical devices, batteries, water purification systems, and even in the chemical processes that produce everyday products. Unlike gold, which is almost never destroyed or lost, silver is often consumed in manufacturing processes. Many of the products that use silver, like electronics or solar panels, have relatively short lifespans, and the silver they contain is rarely recycled. As a result, a significant portion of the 1.7 million metric tons of silver ever mined is no longer accessible. Much of it is scattered in landfills, embedded in obsolete electronics, or locked away in products that are difficult or uneconomical to recycle. This means that the available supply of silver is much smaller than the total amount ever mined, and it's constantly being depleted by ongoing industrial demand. This dynamic creates a unique situation for silver. On one hand, the steady and growing industrial demand for silver provides a solid foundation for its price. There's always a baseline level of consumption that supports the market. On the other hand, because so much silver is consumed and lost, the available supply is much tighter than it appears. This tightness makes silver prices far more volatile than gold's. When demand surges, whether from industry or from investors seeking a safe haven, there simply isn't enough readily available silver to meet that demand without significant price increases. Conversely, when industrial demand drops, silver prices can fall sharply. To put this into perspective, a relatively small increase in investment demand, say just 10%, can cause silver prices to spike dramatically. That's because the market is much smaller and less liquid than gold's, and there's less above-ground inventory to absorb sudden shifts in demand. Gold, with its massive stockpiles, can handle large inflows and outflows of investment without wild price swings. Silver, by contrast, reacts like a coiled spring. Its price can shoot up or down in response to even modest changes in supply or demand. This dual nature, precious metal and industrial commodity, means that silver occupies a unique and sometimes precarious position in the financial world. During times of economic stability, industrial demand tends to dominate, anchoring silver's price to the health of manufacturing and technology sectors. But in times of crisis or uncertainty, investment demand can surge, amplifying both risk and reward. Silver's volatility can be a double-edged sword. It offers the potential for outsized gains, but also exposes investors to sharp corrections. Understanding these dynamics is crucial for anyone considering silver as part of their portfolio, and it's why silver often behaves so differently from its more stable cousin, gold. Beneath the surface-level chaos of market volatility and headlines, there's a powerful, often overlooked force shaping the future of silver: its structural, industrial demand. This demand isn't just booming, it's fundamentally evolving and accelerating, driven by a convergence of technological revolutions and global shifts in energy, infrastructure, and manufacturing. Let's start with the obvious drivers: electric vehicles, solar energy, and artificial intelligence. Each of these sectors is experiencing exponential growth, and all are heavily reliant on silver's unique properties. In electric vehicles, silver is essential for battery connections, wiring, and advanced electronics. Solar panels, especially photovoltaic cells, use silver as a critical component for conductivity and efficiency. Meanwhile, the rise of AI and data centers is fueling demand for high-performance electronics, where silver's superior conductivity is irreplaceable. But that's just the beginning. The rollout of 5G networks worldwide is another massive catalyst. Every 5G cell tower, every advanced smartphone, and every piece of next-generation telecom infrastructure requires silver for its unmatched ability to carry high-frequency signals with minimal loss. Advanced electronics, from medical devices to aerospace systems, also depend on silver for reliability and performance. And as battery technology evolves, whether for grid storage, portable devices, or electric transport, silver's role in new chemistries and designs is only expanding. What we're witnessing isn't a passing trend or a speculative bubble. It's a structural global megatrend. As technology advances and the world transitions to cleaner energy and smarter infrastructure, silver's role becomes more deeply embedded in the fabric of the global economy. The demand is not only broadening geographically, with emerging markets ramping up adoption, but also deepening across industries, from healthcare to transportation to digital finance. On the supply side, the situation is even more complex. Unlike gold, most silver is produced as a byproduct of mining for other metals like copper, lead, and zinc. This means that even if silver prices spike, mining companies can't simply ramp up silver production overnight. The supply chain is rigid, and new primary silver mines are rare and expensive to develop. As a result, production growth lags far behind the surging demand from these new technologies. The outcome? A persistent, long-term structural deficit. Inventories are shrinking year after year, with above-ground stockpiles being drawn down to meet industrial needs. Even as paper markets and financial instruments create short-term noise, the underlying physical market is tightening. This isn't just a cyclical dip. It's a fundamental supply squeeze that's likely to intensify as the world's appetite for silver continues to grow. Ultimately, the real story is about relentless, compounding demand colliding with limited, inflexible supply. This dynamic is setting the stage for silver to play a critical, perhaps even irreplaceable role in the future global economy. As the world races toward electrification, digitalization, and sustainability, silver's importance will only grow, regardless of short-term market chaos. The question isn't if silver will matter, but how soon the world will realize just how vital it has become. When we witness a dramatic collapse in the price of silver, it's easy to assume that the metal itself has suddenly lost value or that demand has evaporated overnight. But in reality, a silver price collapse is rarely about the intrinsic worth of silver as a physical commodity. Instead, it's a glaring signal that the paper market, the vast complex web of futures contracts, derivatives, and leveraged positions, has reached a breaking point. Market experts consistently point out that these crashes are not a reflection of silver's utility or scarcity, but rather a symptom of the instability that comes from excessive speculation and leverage in the financial system. The collapse, then, is not a verdict on silver's usefulness, or its role as a store of value. It's a direct consequence of a market structure where the volume of paper contracts far exceeds the amount of physical silver that actually exists. This leverage creates a disconnect, a divergence between the price you see on a screen and the reality of tangible silver in vaults. As one analyst explains, the paper market can distort prices far from the true value of physical silver, creating an illusion of abundance or scarcity that doesn't match the real world. This distortion is amplified during periods of panic, when traders rush to unwind positions, triggering a cascade of selling that has little to do with the fundamentals of the metal itself. What we're really hearing in these moments is the sound of margin calls echoing across the market and the forced liquidations that follow. These are not judgments on silver's long-term prospects, but rather the mechanical consequences of leveraged bets gone wrong. When prices fall rapidly, traders who borrowed money to amplify their positions are forced to sell, often at a loss, to cover their obligations. This creates a feedback loop, driving prices even lower and triggering more margin calls. Financial experts agree, these violent swings are driven by the architecture of the market itself, not by any sudden change in the underlying value or demand for silver as a metal. In these turbulent times, the distinction between paper and physical silver becomes more important than ever. While the paper price may be collapsing, the real asset, physical silver, remains resilient. Specialists emphasize that even as digital prices plummet, the demand for tangible silver often surges, with premiums rising and physical supply tightening. This divergence highlights a fundamental truth. The value of physical silver is anchored in its real-world utility and scarcity, not in the speculative games played on trading screens. For many investors, these moments of crisis reinforce the importance of holding actual metal, rather than relying solely on paper claims. Ultimately, a silver price collapse is less about the metal, and more about the fragility of the financial system built around it. These events expose the vulnerabilities of a market that relies heavily on leverage, derivatives, and complex financial engineering. Experts warn that such collapses are a wake-up call, revealing deeper structural issues that can threaten not just silver, but the stability of the broader financial system. Investors are urged to look beyond the headlines and understand the crucial difference between paper promises and physical assets, because, in the end, it's the real metal that endures, even as the financial edifice around it trembles. When news of a silver ban hits the headlines and markets spiral into chaos, it's natural to feel anxious. But for the everyday investor, the most important thing is to resist the urge to panic. Take a deep breath, step back, and carefully assess your current portfolio. Ask yourself, are you overexposed to any single asset, or have you built in enough diversification to weather sudden shocks like this? Volatility in the market is often engineered to shake out weak hands, those who react emotionally rather than strategically. This is why it's crucial to set clear, realistic investment goals before a crisis hits, and to stick to your plan even when the headlines are screaming. Remember, short-term price swings are often exaggerated by panic selling and algorithmic trading, but your long-term objectives should remain your guiding star. In times like these, risk management becomes more important than ever. Consider diversifying your assets, not just within precious metals but across different sectors and asset classes. If you're invested in silver, prioritize holding physical bullion over leveraged paper claims or ETFs, which can be subject to counterparty risk and regulatory changes. Physical silver in your possession is immune to digital freezes or sudden policy shifts. The old adage, if you don't hold it, you don't own it, rings especially true during market disruptions. Watch for warning signs, like rising physical premiums, stress in the repo markets, and a growing divergence between paper and physical silver prices. These signals can indicate underlying instability and help you make more informed decisions about your holdings. Don't get caught up in the noise of daily price swings. Instead, focus on tracking long-term trends and the fundamental factors driving the market. If your asset allocation has drifted due to recent volatility, consider rebalancing your portfolio to maintain your desired risk profile. This disciplined approach can help you avoid costly mistakes and capitalize on opportunities that others might miss. Staying informed is your best defense against uncertainty. Set up alerts for major news developments, regularly review your financial plan, and make a habit of learning about the broader economic context. The more you understand about how markets function and how policy changes can impact your investments, the better equipped you'll be to navigate turbulent times. Above all, don't let psychological traps undermine your strategy. Avoid making impulsive decisions based on fear or greed. Instead, focus on your long-term plan, trust the research and preparation you've done, and remember that market chaos often creates opportunities for those who remain disciplined and informed. By keeping your emotions in check and your strategy clear, you'll be far better positioned to protect and grow your wealth, no matter what the headlines say. The recent upheaval in the silver market is more than just a story about a single commodity. It's a profound lesson in how systemic stress reveals itself across the entire financial landscape. Silver, in this context, acts as a barometer, reflecting deeper issues within the system rather than being the root cause itself. When we witness sudden volatility or dramatic price swings, it's not simply about supply and demand for silver, it's a signal that something fundamental is shifting beneath the surface. And these moments urge us to look past the headlines and dig into the underlying mechanics that drive such chaos. The so-called paper crash in silver is not a reflection of the metal's intrinsic weakness, but rather a symptom of a much larger, systemic illness. The proliferation of paper contracts, derivatives, futures, and other financial instruments has created a market where the volume of promises far exceeds the actual physical supply. When confidence in these paper claims erodes, the entire structure wobbles, exposing the fragility of a system built on trust rather than tangible assets. In these moments, it becomes clear that the real risk lies not in the asset itself, but in the layers of abstraction and leverage that have been built upon it. What we're witnessing is a chaotic repricing, a dramatic shift in perceived value from paper representations to real, tangible assets. As uncertainty grows, investors and institutions alike begin to question the reliability of paper claims, seeking refuge in physical holdings that cannot be easily duplicated or defaulted upon. This migration of value is not just a financial event, it's a psychological one, as trust is reallocated from abstract promises to concrete reality. In times of market stress, tangible assets like silver and gold become anchors, providing a sense of security and stability amid the storm of volatility. To navigate these turbulent waters, it's essential to develop the ability to see through the noise and identify the true signals. This means questioning the narratives presented by mainstream media, understanding the incentives of market participants, and recognizing the difference between short-term panic and long-term structural change. Ask yourself, what is genuinely valuable, and what is merely a product of speculation or leverage? The ability to discern reality from illusion is perhaps the most valuable skill an investor can cultivate in today's complex financial environment. Ultimately, the silver market's turmoil is a microcosm of a much larger conversation about the future of money and the stability of our financial systems. As we stand at the crossroads between the old world of physical assets and the emerging landscape of digital currencies and decentralized finance, the core lesson is clear: stay curious, question the prevailing systems, and protect your wealth by understanding what truly holds value. In a world where trust can evaporate overnight, knowledge and discernment are your greatest assets. As we wrap up this chapter, remember, the story of silver is not just about a metal or a market event, it's about the ongoing evolution of money, trust, and the foundations of our economic lives. With these insights in mind, let's move to our final thoughts and closing message. For decades, silver has been at the heart of the global financial system, valued not just for its industrial uses or its beauty, but as a store of wealth and a hedge against uncertainty. Yet, what we're witnessing now isn't a failure of silver itself. Instead, it's the unraveling of the complex, opaque system that has been constructed around it, a system built on layers of paper contracts, promises, and financial engineering that often obscure the true value of tangible assets. For years, the financial world has relied heavily on paper silver, futures, options, and other derivatives that far exceed the actual physical supply. These instruments have allowed institutions to trade vast quantities of silver on paper, often with little or no intention of ever taking delivery of the real metal. This has created a disconnect between the price you see on a screen and the true availability of physical silver, masking the real value and scarcity of the asset. Now, As stress fractures appear in the system, triggered by surging demand for physical silver, delivery delays, and growing skepticism about the solvency of major exchanges, the truth is coming to light. Investors and institutions alike are being forced to confront the vulnerabilities that have been papered over for years. This reckoning is driving a fundamental repricing of assets, as the market begins to reassess what is truly valuable and what is merely a promise on paper. In this environment, knowledge is your best defense. It's crucial to understand the difference between holding a paper claim, such as an ETF or a futures contract, and owning physical silver that you can actually touch and store. Paper claims are subject to counterparty risk, regulatory changes, and even outright default, while physical ownership provides a level of security and independence that paper simply cannot match. In times of uncertainty, it's easy to be swayed by sensational headlines and short-term volatility. But managing your risk means thinking long-term, staying calm, and not letting the noise of the moment shake your conviction. The most successful investors are those who can filter out distractions and focus on the underlying fundamentals. The real story here isn't just about wild price swings or sudden market moves. It's about a deeper loss of faith in paper assets and a growing recognition that real tangible wealth, like physical silver, offers protection against systemic risk. As more people question the reliability of paper promises, we're seeing a shift toward assets that are lasting, finite, and outside the reach of financial manipulation. In this new reality, it's more important than ever to stay rational, stay informed, and question the narratives you're told. Don't accept conventional wisdom at face value. Dig deeper, seek out multiple perspectives, and make decisions based on evidence, not emotion. As the system is exposed and the old certainties are challenged, the best course of action is to educate yourself, diversify your holdings wisely, and be proactive in preparing for what comes next. The future will belong to those who take responsibility for their own financial security, those who are willing to learn, adapt, and act decisively. Remember, in times of upheaval, preparation is not just an advantage, it's a necessity. Narrator 1.1x. The silver market chaos is more than a headline, it's a wake-up call. The time to act is now. Reflect on what truly holds value, take control of your financial destiny, and don't wait for the system to decide your future. The choices you make today could define your security.